Welcome back to the deep dive. Today, we're going to look into something that's pretty important for, well, anyone who reads financial statements. You know, whether you're an investor or just trying to get a handle on how companies present, well, how they're doing financially.
Yeah, we're talking about IFRS 18, a big change to the rules around presenting financial performance, specifically how companies report their profit and loss.
So it's like a fundamental update to how we're going to be seeing these reports in the future.
Exactly. And to really get to the bottom of this, we've been going through tons of documents from the IASB, the folks who set these international accounting standards.
Lots of dense reading. So what's the mission for today's deep dive? What are we hoping to really unpack?
Well, we want to give you a clear picture of what these new rules actually are, why they're being introduced now, and probably most importantly, what the main changes are going to be when you're looking at a company's income statement, which a lot of folks still call the profit and loss statement.
And this isn't just for the accounting nerds, right? I mean, this affects anyone trying to understand a company's performance.
Absolutely. Whether you're looking at a potential investment, sizing up a competitor, or just want to be more informed about financial news in general, IFRS 18 is going to change the way you see those reports.
Okay, so let's start with like the basics. What was so wrong with the old way, the way things were done under IAS 1?
The biggest problem was, frankly, the lack of consistency in how companies were presenting their statement of profit or loss. Under IAS 1, the old rules, there weren't any specific subtotals required between a company's top-line revenue and its final profit or loss number.
So like there was all this flexibility, which I guess at first glance might seem like a good thing.
But in practice, it created a real mess.
Yeah, I remember reading something about like how many different ways companies were defining even simple terms.
Oh, it was wild. There was a study that analyzed 100 different companies, and get this, they found at least 9 different definitions for operating profit. 9.
That's crazy. So you could have two companies, even in the same industry, and their operating profit could mean totally different things.
Precisely. It made comparing companies incredibly difficult. And, it kind of allowed companies to present a potentially misleading picture of how profitable they truly were at their core.
So IFRS 18 is trying to, I guess, clean up this mess. How's it going to do that?
Well, it's introducing a much more structured approach to the profit and loss statement. Now, there will be specific categories and subtotals that all companies have to use.
Okay, so more uniformity, more like a common language for everyone. What are these new categories?
Yeah, there are 3 main ones: operating, investing, and financing. This way, income and expenses are categorized based on what kind of activity they came from, which makes a lot of sense.
So will we literally see like operating, investing, financing as line items on the income statement?
Well, it's interesting. IFRS 18 doesn't actually require companies to show a separate subtotal or even a heading for each of those 3 categories on the face of the statement. But it does lay them out as the foundational structure for how the income and expenses should be organized internally. And of course, any existing requirements for other subtotals from other standards, those still apply.
Got it. So more internal organization than necessarily a ton of new line items popping up, but there are some new required subtotals, right?
Yes, that's right. IFRS 18 introduces 2 new required subtotals: operating profit and profit before financing and income tax. These will have to appear on every company's statement of profit or loss.
So those become really key numbers for comparison across companies, right?
Exactly. They're going to make it a lot easier to assess core profitability in a consistent way, no matter what quirks a company might have had in its reporting before.
Okay, let's dig into each category. What exactly falls under operating?
Think of operating as the default category. It includes all income and expenses that aren't specifically classified as investing, financing, or income tax. It also excludes anything from discontinued operations. Essentially, it covers everything that comes from the company's main business activities.
So if a company, say, makes and sells shoes, their revenue from selling those shoes and all the costs of making them, that would all be operating.
Yes, exactly. And it's important to note that operating also includes things that might be considered unusual or one-off, like a big gain from selling a piece of equipment, as long as it's related to the company's main business.
So it's really about capturing the full picture of the core business, even those less frequent events. What about investing then? What goes there?
Investing is for income and expenses that come from assets the company owns, but that aren't part of its core operations. These assets are held mainly to generate a return, often independently of the company's other resources.
Like what specifically?
Well, think about rental income from an investment property, or changes in that property's value, or interest income earned on financial assets the company's holding, and any changes in those assets' value. Dividends from investments in other companies where they don't have control, and changes in the value of those investments would also be here.
Okay, so it's really about those investments outside the main business. What about the costs of managing those investments?
Right. Any expenses directly related to acquiring or selling those investment assets, like transaction costs or fees, those are classified as investing too. And usually for companies that aren't financial institutions, their income and expenses from cash and cash equivalents would be investing as well, since that's generally considered an asset held for return.
Makes sense. So we have operating the main business, investing the returns from specific assets. That leaves us with financing. What's that all about?
Financing deals with income and expenses that come from a company's liabilities. But here's where it gets a bit more nuanced. IFRS 18 distinguishes between two types of liabilities: financing liabilities and other liabilities.
Okay, and what's the difference?
Financing liabilities are essentially those liabilities where the main purpose was to raise money. Think loans, bonds, things like that. The company gets cash now and promises to pay it back later, usually with interest. Other liabilities are liabilities from other kinds of transactions. A good example is a lease liability, where the company gets to use an asset but has to make payments for it. It's not just about raising money.
So loans are purely for getting cash, while leases are about getting to use something.
That's a good way to think about it. Now, all income and expenses from financing liabilities are classified in the financing category. But for other liabilities, it's only the interest expense and the effects of interest rate changes that go in financing. Other costs related to other liabilities, if they're from the main business, would typically be in the operating category.
Interesting. So for a lease, the actual payments wouldn't be considered a financing expense under this new rule.
You got it. The standard even gives some specific examples, like financing liabilities include things like debt instruments, corporate bonds, bank loans, that kind of thing. Other liabilities would be stuff like those lease liabilities, liabilities for defined benefit pension plans, even provisions for things like litigation.
And just to be clear, net interest expense on those pension liabilities, that's specifically going to be in the financing category now.
Yes, that's right.
Okay, well, this is already a lot more organized than what we had before. Let's switch gears a bit and talk about management-defined performance measures, those MPMs. What's changing with them under IFRS 18?
This is a big one, and it's all about making things clearer for investors and anyone else using financial information. MPMs are those subtotals of income and expenses that companies often talk about in their communications outside their formal financial statements. Things like press releases about earnings, presentations to analysts, that kind of thing. These are metrics that aren't defined by IFRS, and they often reflect how management sees the company's performance.
Oh, yeah, we see these all the time, right? Adjusted EBITDA, underlying profit, all those sort of non-GAAP numbers.
Exactly. You also have things like adjusted operating profit, adjusted profit or loss, and sometimes even free cash flow or return on equity, though technically those two themselves aren't MPMs, but the profit figures used to calculate them often are.
Okay, so companies have been using these for a while. What's the problem IFRS 18 is trying to fix?
The problem has been the lack of transparency and consistency in how these MPMs are calculated and presented. It's been hard to know exactly what management is adjusting for and why. So IFRS 18 is putting in some new rules specifically about disclosure. Now, companies will have to provide very specific disclosures about any MPM they use, and all these disclosures will have to be in one dedicated note in the financial statements.
So no more hiding those adjustments in the fine print. And what kind of info will they have to disclose?
Well, first, they'll have to say outright that the MPM is based on management's view of performance. Second, they have to explain why they're reporting this particular MPM, what insights they think it gives. Third, and this is huge, they have to give a detailed reconciliation showing how they got to that MPM number from the closest comparable IFRS figure. This reconciliation will also have to show the effects of the adjustments on things like income tax and non-controlling interest. And finally, they'll need to explain any changes they've made to how they calculate the MPM compared to previous periods.
So it's like giving us a map to trace those adjusted numbers back to the official accounting figures. Now, if those MPM disclosures are part of the financial statements, does that mean they'll get audited too?
Yes, exactly. By putting those disclosures in the notes to the financial statements, they fall under the scope of the audit, which makes them a lot more reliable.
Okay, moving on. IFRS 18 also tackles aggregation and disaggregation. Can you explain what that means in simple terms?
It's all about how companies group information together or aggregate it in their financial statements and the notes, and when they should break information down or disaggregate it. The basic idea is to aggregate things with similar characteristics and disaggregate things that are different. This is to make sure important info isn't hidden by lumping it in with unrelated stuff.
So the financial statements themselves should be like a summarized overview, and then the notes give you the details.
That's it. The financial statements should give you a useful, structured summary, and then the notes provide more specific details and explanations. The standard also discourages companies from just using the label Other for grouped up items without explaining what's in there. If a significant amount is labeled as Other, they'll likely need to give more detail in the notes.
What about operating expenses presented by function? There was something about that in the outline.
Right. If a company presents their operating expenses on the income statement based on their function, like cost of goods sold, selling expenses, admin expenses, things like that, then they'll need to give more detail in the notes about the nature of those expenses. They'll have to break down things like depreciation, amortization, employee benefit costs, and impairment losses that are included in those functional categories.
Got it. So more transparency behind those broad expense categories. Now let's talk about the statement of cash flows. How does IFRS 18 affect that?
Well, it brings some pretty important changes to IAS 7, which is the standard for the cash flow statement. The biggest change is that the operating profit or loss, subtotal, which is now required under IFRS 18, will be the starting point for the indirect method of reporting cash flows from operations. This applies to all companies that use the indirect method.
So that ties the cash flow statement back to the new profit and loss statement more directly. Were there any other impacts on how cash flows are categorized?
Yes, there are. The options companies had for classifying cash flows from interest and dividends, those are being eliminated for many entities. Now, the classification will mostly have to follow how those same income and expenses are classified in the profit and loss statement under IFRS 18. This applies especially to companies with those specified main business activities we talked about earlier, and it's all about making the two statements more consistent.
Okay, so lots of changes coming. When do these rules actually kick in?
IFRS 18 becomes effective on January 1st, 2027, and all the requirements, including the changes to other standards, have to be applied at the same time.
So come 2027, companies' reports will look quite different. Will they have to go back and restate their past financials too?
Yes, they will. IFRS 18 is applied retrospectively. That means when a company adopts it in 2027, they'll have to restate their comparative figures for prior periods in both their interim and annual statements, so those older periods are also presented using the IFRS 18 format. Plus, in that first year of adoption, they'll have to give a reconciliation showing how the new presentation affected their profit and loss statement for the previous comparable period.
That makes sense. So we can actually compare apples to apples. Now let's talk about those specified main business activities you mentioned earlier. Can you explain what that's all about and why it matters for classification?
Sure. So a company is considered to have specified main business activities if its core business is either investing in assets or providing financing to customers, or sometimes both. And a company can have more than one of these. Let's say you have a company that sells furniture, right? Their main business is obviously selling furniture. But let's say they also have a separate large financing arm that gives loans to customers to buy that furniture. That financing activity becomes one of their specified main business activities, and that changes how certain income and expenses related to that financing are reported.
Okay, that example really helps. What are some other types of companies that might fall into this category?
Well, typical examples would be investment funds, real estate investment companies, insurance companies. Those would likely have investing in assets as a main business activity. Then you have banks, lending companies, and like we said, companies with those customer financing arms, they would fall under providing financing to customers.
So it's not just about what brings in the most revenue, but about the core nature of the business.
Exactly. And whether a company has these specified main business activities is assessed both at the consolidated level for the whole group and at the individual entity level. So a parent company and one of its subsidiaries might actually have different main business activities, which could mean they classify some things differently in their statements.
Sounds complicated. What are some of the specific classification differences for these types of companies?
Well, for example, under the general rules, income and expenses from cash and cash equivalents are usually classified in the investing category. But if a company's main business is investing in financial assets, then those cash and cash equivalent items go in volume, operating instead. Similarly, if a company's main business is providing financing to customers, the interest they pay on their own borrowings that are used to fund that customer financing, that interest expense is classified as operating instead of financing. But keep in mind, income and expenses from investments where the company uses the equity method, those are always investing, regardless of the main business. And if a company's main business is investing in non-equity investments, those go in operating.
Okay, definitely some nuances there. Switching to the balance sheet for a moment, any changes there under IFRS 18?
Just one notable one. IFRS 18 requires goodwill, which you often see after a merger or acquisition, to be presented separately on the balance sheet. It makes it a lot easier to spot.
And finally, any effects on other accounting standards?
Yes, definitely. We already talked about the impact on IAS 7 for the cash flow statement. IFRS 18 also leads to changes in ISS 33, which is about earnings per share. Now, companies will only be allowed to present additional earnings per share figures beyond the basic and diluted EPS if the profit figure they're using in the calculation comes from either IFRS 18 itself or if it's one of those management-defined performance measures that they're disclosing under the new rules.
So everything stays aligned with the new way of presenting profit. What about interim financial reporting, those quarterly reports?
IAS 34, which covers interim financial reporting, is also affected. Now, companies will have to disclose those MPMs in their interim reports, and the disclosure will be the same as what's required in the full annual statements. So investors and analysts will have that info on a more frequent basis.
Well, this has been a deep dive indeed. Seems like IFRS 18 is going to shake things up quite a bit. But the goal is to make things clearer and more comparable, right?
That's right. By standardizing how the profit and loss statement is structured and presented, and by requiring much more transparency around those MPMs, IFRS 18 should give everyone a much better understanding of a company's true performance.
So for you, our listener, the main takeaways are that come 2027, company profit and loss statements will look different. You'll see those standardized operating, investing, and financing categories, as well as those key subtotals like operating profit. You'll also get a lot more detail about those adjusted metrics companies use thanks to those mandatory reconciliations. All of this is going to be key for understanding financial reports going forward.
And it really makes you think, as these new rules come into play, how might this shift in how companies report their financials actually change how investors evaluate them? Will it lead to a different set of questions about a company's profitability and long-term prospects? It'll be fascinating to see how this all unfolds.
Definitely a lot to keep an eye on. Thanks for joining us for this deep dive into IFRS 18. Until next time.